If a single stock has become a large part of your wealth, selling it may feel as risky as holding it. Hold it and your financial future remains heavily dependent on one company. Sell a large amount at once and you may trigger a significant tax bill. There's several strategies available to reduce a concentrated stock position these days. One strategy that some investors consider is using covered calls as part of a gradual diversification plan. I personally used covered calls for many years to diversify my concentrated stock. Covered calls generate income from shares you already own and potentially create a disciplined framework to diversify a concentrated position over time. But all strategies to reduce the concentration risk come with trade-offs, and a covered call strategy is no different. They're not the right fit for every stock or every investor. They can limit your upside if the stock rises sharply while providing limited protection if the stock declines significantly. In this video, I'll explain how covered calls work, why some investors, including me, use them to help diversify concentrated stock, the risk involved, how rolling works, and finally, a practical framework to think through the tax and diversification trade-offs. Hi, I'm Aaratee, founder of Aure Financial. I've spent more than 20 years at the intersection of finance and technology in Silicon Valley, including executive roles at major tech companies and leading financial institutions. On this channel, I break down practical tax, investing, and wealth management topics for high-income Californians. In this video, I'll cover using a covered call strategy to help diversify concentrated stock. This is especially relevant if a meaningful part of your net worth is tied to a single public company stock. We will cover what is a covered call, why do investors use covered calls for concentrated stock positions, what are the key risks and trade-offs, what does it mean to roll a call when you want to keep the shares, and finally, a simple framework to consider before using a covered call. Before we get into the details, this video is for educational purposes only. Options involve risk and they're not suitable for everyone. So please consult a qualified financial or tax professional about your personal goals before implementing any strategy. Let's start with a hard question. Why not just sell the concentrated stock and diversify right away? For high-income Californians, taxes can be a major part of that decision, especially when the stock has a very low cost basis. Selling a large appreciated stock in 1 year can create a significant tax bill. For a California high earner, the combined federal and state tax rate on long-term capital gains can be roughly 37% as compared to about 23.8% for a similar investor in a state with no income tax in 2026. California has no preferential rate for long-term capital gains. But taxes are not the only risk. Concentration risk can be much more expensive than the tax bill. If one stock represents more than 50% of your investable net worth and that stock falls sharply, the damage to your financial plan can be far greater than the tax cost of diversifying. If the position is significantly concentrated and the stock is extremely volatile, sometimes the cleanest answer is to sell part of it, pay the taxes, and diversify. Covered calls can be part of the diversification plan, but the greater the concentration, the less likely it is that a covered call strategy alone will be enough. Now let's cover the basics. What is a covered call? A covered call is an option strategy where you own shares of a stock and sell a call option on that same stock. Selling a call option gives another buyer the right to buy your shares at a specific price called a strike price at or before an expiration date. In exchange, you receive money called the option premium, which is yours to keep. If the stock rises above the strike price and your shares are called away, they are sold at the strike price. But if you include the option premium received, your effective sale price is your strike price plus the option premium received. So the basic idea is simple. You receive income today, but you give up some potential upside above the strike price. That is the core trade-off. Let's walk through a simple example to understand this better. Let's say you own 10,000 shares of ABC Corporation. The stock trades at $100 per share. That means your position is worth $1 million. You sell 100 covered call contracts because each options contract covers 100 shares. You select a strike price of 110 expiring in 4 months and you collect $10 per share in option premium. That means you receive 100,000 in income from the covered calls. Now let's look at 4 possible outcomes. Scenario 1. The stock stays flat at 100. If you had only held the stock, you would have no gain or loss. With the covered call, you still own the stock and you collected $100,000 in premium. Scenario 2. The stock rises a little to 105. Your stock is up $50,000. You also collected $100,000 in premium. So your total return is $150,000. Scenario 3. The stock rallies sharply to 125. If you had simply held the stock, your gain would be $250,000. But with a covered call, your shares may be called away at 110. You make $100,000 from the stock moving from 100 to 110, and you keep the $100,000 premium. So your total gain is $200,000. That is still a gain, but you're 50,000 behind the stock only outcome. That is the opportunity cost. Scenario 4. The stock drops to $80. If you only held the stock, you would be down $200,000. With the covered call, the 100,000 premium offsets part of the loss. So your net loss is $100,000. That is better than losing $200,000, but it is not full protection. This example shows the core pattern. Covered calls can help in a flat, slightly rising and slightly declining markets, but they can hurt relative performance in a big stock rally, and they do not protect you from a significant stock decline. Now, investors like me may use covered calls as part of concentrated stock diversification strategy mainly for two reasons. First is to create a disciplined plan for gradually selling shares, and second is to support tax-aware selling across multiple years. Covered calls can create a disciplined diversification plan. Many investors know that they overconcentrated, but they still delay selling, sometimes because of taxes, sometimes because they believe strongly in the company, and sometimes because they're afraid of missing the future upside. A covered call can force you to make some of these decisions by asking questions like, at what price are you comfortable selling some shares? How much of the position do you want to reduce this year? How much tax do you want to realize this year and the next year? And how much of your net worth are you comfortable keeping in one company? One way to think about a covered call is it helps you to pre-commit to a target sale price. With this approach, the investor still owns the stock, continues to collect dividends, if any, and continues to bear the company's specific risk. But it can support a gradual path towards diversification if the covered call income and dividends are reinvested into diversified assets or set aside to help pay for taxes as shares are sold. Covered calls can also support tax-aware selling across multiple years. Selling a large appreciated stock position in a single year can create a significant tax bill. For high-income California investors, long-term capital gains can face a combined federal and state tax rate of roughly 37% as compared to about 23.8% in a state with no income tax in 2026. California has no preferential rate for long-term capital gains. A covered call can spread sales across multiple tax years as shares are gradually called away, and the cash received from the covered call option premium and dividends can help fund the resulting tax bill. But this needs to be modeled before the trade is placed because assignment can create a taxable sale, especially if you're writing covered call on low basis shares. Now let's go through some of the risk and trade-offs of a covered call strategy. Risk number 1, the strategy requires active management. This is not a set it and forget it strategy. You need a process for selecting the strike price and the expiration date, deciding whether to close the covered call, roll it, or accept the assignment, and reinvesting the option premium income consistently. Shares can also be called away before expiration, with the risk increasing around ex-dividend date. If that happens, the stock sale occurs earlier than you may have planned, creating a taxable gain in that year. So active tax management is also required. Risk number 2, your upside is capped. When you sell a covered call, you give someone else the right to buy your shares at the strike price. If the stock rallies far above the strike price, you give up the additional upside on those shares. If you decide you want to keep the shares, you may be able to roll the covered call, and we'll talk about how that works shortly. Risk number 3, the stock can still decline significantly. A $10 premium does not meaningfully offset a $30 decline, and with a concentrated position, a sharp decline can have a significant impact on your overall portfolio. Now, what to do when you want to keep the shares? One of the most useful adjustments in a covered call strategy is rolling. Let's say you sold a covered call because you were comfortable selling the stock at a specific price, but the stock rallied faster than expected and your shares are now at risk of being called away. At that point, you have a few choices. You can let the shares be called away. You can buy back the call and close the position, or you can roll the option. Rolling means buying back the existing covered call and selling a new covered call with a later expiration date, a higher strike price, or both. Now, why would someone do this? Investors usually do this if they're not ready to sell the shares right now, or they want to defer the sale to a next year, or they want more upside before they're willing to sell. But rolling is not free. If the stock has moved up significantly, buying back that original call can create a realized loss on the option. Now, that may sound negative, but sometimes it can be useful from a tax planning perspective. In many standard covered call situations, that realized loss on the option can help offset capital gains by selling a part of the concentrated stock this year while you roll the covered call to the next year. This is one of the reasons why covered calls can be useful in concentrated stock planning. However, the details matter, so please take professional tax advice here and model the tax impact before rolling. And most importantly, rolling should not become a way to avoid making the bigger decision. If the position is too concentrated, you eventually need a plan to reduce the risk. Now let's talk about a practical framework for a covered call strategy. Before writing covered calls on a concentrated position, work through these 5 questions. Number 1, how concentrated is the position? If one stock represents more than 50% of your investable net worth, concentration risk can be much more expensive than the tax bill. Sometimes the cleanest answer is to sell part of it, pay the tax, and diversify. Number 2, how much of the position are you genuinely willing to sell? Write covered calls only on shares you would be comfortable selling at an effective price equal to the strike price plus the premium received. Number 3, what tax impact would the assignment create? Model the tax cost at each strike price, including the premium received, before placing the trade. Number 4, what will you do with the premium? The income from a covered call should have a purpose such as reinvesting it into diversified assets or setting it aside for future tax payments. And finally, number 5, what is a broader exit strategy? A covered call should fit within a broader plan for reducing concentration, managing taxes, and building long-term wealth. It should not be the only strategy. Covered calls tend to work best when the investor is not trying to maximize every dollar of upside. They are worth considering when you are willing to sell some shares at an effective price equal to the strike price plus the premium received, and you understand that your upside is capped above that level. You want to gradually reduce concentration over time. You are comfortable with the downside risk of owning the stock. You are coordinating the strategy with your tax plan. You have a process for actively monitoring the position and deciding whether to roll, close, or accept assignment. Covered calls can be a useful tool for investors with concentrated stock positions, specifically those who want to create a disciplined selling framework and gradually diversify over time. They require active management and should be evaluated as one component of a broader after-tax wealth plan along with other strategies. The goal is not simply to generate income from covered calls, but to make better decisions about your taxes, risk, liquidity, and your long-term wealth. If you found this helpful, please subscribe for more videos on tax-efficient investing and tax planning for high-income Californians. And if you need help to think through your own cash management, tax management, and portfolio management, you can learn more on our website, aurefinancial.com. Thank you for watching, and I'll see you in the next video.